Yeah, hi traders, it's Chris Weston here, Head of Research at Pepperstone. So we find ourselves back again looking at the gold market. We do this on a weekly basis, and it's really important to us to build a community around gold. You know, here at Pepperstone, we just released ETFs, we just released soft commodities and agricultural commodities. But gold, specifically XAUUSD, continues to be our most traded product by quite some way. People trading off 2-minute charts, 5-minute charts, swing and momentum scalping. A lot of people using expert advisors and mechanical systematic strategies, people using longer term timeframes, you know, hourly, daily, 4-hour charts and using their own discretion. Whatever the situation is, gold is very important to us. So if you find yourself liking the video, yeah, hit the like button, hit the subscribe. But really importantly, if you've got your own comments or own feedback or views on gold, which I know a lot of people have because you're very passionate about gold, leave it in the commentary field and we can build up a bit of a community around this video going forward. And I think it can be really important. But I think that probably a really great place to start is the currency effect. So I want to have a look at how gold's traded in various currencies, and to do that, I want to have a look at how currencies are performing. So if you have a look at the chart here, you can see Aussie dollar down 60 basis points since the start of the week. The Aussie has been your weak performer there, and I think a lot of that is down to what we're seeing in lockdowns, not specifically about what's happening in the short term, because we know that the economy will bounce back into Q4, providing we don't get further lockdowns. But I think when you're looking at the diverging trends amongst central banks, there's a big view out there that the Reserve Bank, who are looking to cut back on their QE purchase rate from about 5 billion Aussie dollar bonds a month down to about 4 starting in September. Well, given the fragility we're seeing in retail spending, we're seeing in business and consumer confidence, that decision may reverse, and they actually may reverse that decision and do a pivot. That puts the RBA at one of the most dovish central banks that we're seeing out there. And therefore, you have seen a situation where people have expressed that by selling the Australian dollar. And if you look at the daily chart of the Aussie, you can see it in quite a strong downtrend. So, you're going to see that in XAUAUD, which we'll have a look in a second. You can also see the pound down about 0.4%. You can see the dollar's fairly flat and dollar yen up 6 basis points there. Euro dollar, which we're just saying this ahead of the ECB meeting, down about 0.1%. So what's that mean in gold in different currencies? As you can see here, you can see that XAU USD is down 70 basis points. So being short of gold in the strongest currency is always a great place to be. You can really maximize that P&L effect by looking to short gold in the strongest currency, or what is perceived to be the strongest currency, which in this week has been the US dollar. You can see that gold in Aussie dollar terms is down, but it's down by less. It's 0.1%. And also you can see in euro terms. So gold really has fallen in all currencies. Silver as well in US dollar terms has had that bigger move down, but we'll have a look at that in a second. I think what's really important as we go into the new week will be what's happening in the bond market. And really, I think the focus for everyone who's trading gold, whether you're trading the US dollar, whether you're trading rates, whatever you're trading, is going to be looking up ahead next week at the Fed meeting. So 4 o'clock Eastern Standard Time, you're going to see the press statement coming through, the policy statement from the Federal Reserve. We've got a few splutterings of sort of tier 2 data ahead of that, things like durable goods, new home sales, house price index, but I don't think they're going to really affect markets too much. But what we're trying to understand for people who are trading the dollar and people who are trading the second derivatives such as gold is the timeline for the Fed to look to taper. We know that inflation's fairly sticky. It's probably going to be around for a lot longer than most policymakers were expecting. But at the same time, people are trying to understand what the Delta variant is going to mean for growth going forward. People have ratcheted down their Q3 growth estimates, and certainly some of the reopening stocks have been quite volatile on the back of that. But I think what we're looking for here, and what could send some volatility into the bond market and also the US dollar and then things like gold, is whether we're going to get extra clarity that they're looking to taper its asset purchase program probably sooner, which they could set up at a signal for the 28th of August Jackson Hole Symposium, where Jerome Powell is going to be speaking. So 4 o'clock next Thursday is going to be a biggie. The market's going to be looking ahead of that. Things like rates, things like bonds, US dollar, gold are all going to be fairly susceptible to that. So that's the big event risk that we need to look out for the week. Let's have a look at the bond market, because what we've discussed before on quite a few occasions is the influence that the bond market has on the gold price. And the reason is that gold fundamentally has no yield. That's where it gets its store of value. So when you're seeing a situation where bonds are bid across the world, and bond yields are falling as prices rising, people are buying and bond yields, the expected returns are falling, the gold market looks relatively more compelling to own. If the yield on the offer here is diminishing and becoming even more negative when you adjust for inflation, gold is becoming somewhat more compelling to own, and that's where you see. So if real yields are going up, or if nominal treasury yields are going up, gold prices tend to fall, and when yields are going down, gold prices tend to rise because they look on a relative basis. And what we've been seeing here is there's been all the talk of the last week has been really about what's happening in the US bond market. If we have a look at this chart here, you can look at the nominal US 10-year treasury, which has come from 177. Back in March, it fell basically to 112. It fell through the 200-day moving average. But now we've seen this pin bar reversal. And what we've seen is the follow-through move to the upside. So sellers have continued to kick this through. Price has gone down. Yields have gone up. We've kind of filled the gap that we saw on this move here. And we're just sort of oscillating around this 200-day moving average. So it's kind of hit and miss. Last week, we talked about what was happening in the bond market, and we probably said that if real yields would continue to fall, if nominal treasury yields were going to continue to fall, then gold prices should move up into that sort of 1850 region. That's obviously not happened, and we've seen this rebound here. And the risk we said that was going to happen is if yields were going to rise, then gold prices were going to fall, and that's kind of where we've been. So this is a really interesting trade as we go into that Fed meeting next week. We've seen that higher high after the pin bar reversal. If this can build and move up into 135, perhaps 140 on the 10-year, then gold prices are going to look vulnerable and they're going to face headwinds, and we'll probably find sellers on any kind of rallies. If we look at slightly shorter duration bonds, the 5-year treasury, we've moved back up into this prior swing, the sort of July swing. If this can build here and people sell off this and this pushes up into 85 basis points, that's going to be something that you should probably have on your radar if you're trading gold, because if short end, the belly of the curve is going to continue moving higher, then gold prices are going to find sellers. So that's a really big risk as we go into the Fed meeting, and that's going to probably put a bid into the US dollar as well. So that's something that we do need to focus on. Okay, let's crack on with what we're seeing in the commodity land. And I want to go straight to gold in US dollar terms. And obviously you saw the really big move. A lot of people remember the move that we saw from March into June. We traded down into the sort of 50%. We broke through that level now, but we're actually holding on for dear life into that level now. You can see this kind of horizontal line. Let's take that down into the 1-hour chart and just have a look at how that's performing, because you can see that there's really good support into this kind of red zone, which is 1797 down into the low 90s. But you can see good bids coming through. It's very difficult for me in this situation, knowing that bond yields have been moving higher, to really take anything but a sort of a neutral to negative view at the moment, until we can get the flow of capital moving back above 1806. I think we really need to see. You can see clear supply coming into the market when we get here. It's rolling over. So I really want to see 1806 taking out before I can get bullish, or even start feeling a bit more constructive about owning gold and trading that from the long side there. But let's go back to the daily chart. Again, you can just see when we trade into here, there's really good support coming through. So it just shows you just how important this level is. If this goes, then we are going to see a move back down into these lows, 1765. You can see stochastic momentum is to the downside, and we've got holding below that 5-day exponential moving average, which is gradually tipping down. So I've got a slight bearish bias. I've got a tactically bearish bias because treasuries are moving higher. If we break through these levels around 1797, I will be looking to be short for a move down into 1765, looking to really sort of ramp up my sort of more constructive bullish exposure once we close through the 5-day exponential and back above this 1806 level, which we talked about there. Let's have a look at gold in Aussie dollar terms, because that has been one of the better performance. You've seen this pin bar reversal playing through. The sellers have kicked on. That's a really interesting trade. Now, what's going to happen with the Aussie dollar gold price? Put this on the radar, because we've broken through the uptrend. We've got this pin bar reversal where we've seen the follow through selling playing through. The 38.2% retracement comes in around 2434, and that's just around this kind of low. So if we're going to see the buyers step in and really support, it really needs to come in this kind of zone. If we're going to get the pullback from a profit-taking exercise, and if gold's going to make a rally and we're going to see that Australian dollar weak, then this could be an interesting trade. We really want to see if price can get down into this 24.37 region, support, and then push through again. But if that continues to roll over and build from this position here, which we can see stochastic momentum is moving to the downside, that again could be one that we could look at from the short side as well. Gold in euro dollar terms, well, that's in a similar situation. Again, we're looking at the ECB meeting. We've got this series of lows that play through here. So that really needs to hold around here. And if that just takes out, again, that could be quite weak. And let's have a look at what's happening in the Japanese yen. So again, a bit messy chart. Let's have a look at what's going on in the other variables. So we can take a view that that we're taking a modestly bearish view, and that could accelerate on through 1795. We're taking a more positive view if it goes through 1806. But let's have a look at some of the sort of other trading variables that we're seeing. Let's have a look at positioning to start with. Immediately, I want to have a look at futures position held by managed money. These are people who are managing futures position, and we're looking at the net effect at the moment. You can see here that this is as of last Tuesday, and it was reported on Saturday. So it's a little bit stale, and given the move down, I guess there's probably, the net position at the moment of the market being long 103,000 contracts. It's probably a little bit lower than that situation now, but the market's still long. They've been building on these longs. I'd imagine that will probably be down a little bit now, but the market's a little bit long. It's not at any kind of levels where I'd say we're going to get this crazy profit taking playing through, but the market is long. If we have a look at the GLD positioning, you can see a situation where outflow, maybe this is probably the more real-time situation, but the GLD, which is the ETF, which we've now just rolled out to clients as well, you can see the cumulative money flow has been money has been flowing out of bonds, out of the ETF, and I think that tells you a lot about the semantics playing through. You can see the blue histogram, these consecutive periods of people taking money out of the GLD. The money flow has been negative, and I think that's something that has really sort of pricked my interest. If you have a look at our own client positioning, and if you have a look at the long short skew that we've been seeing, 67% of clients are currently long gold, 33% are short. Silver's a bit more interesting there. You've got 84% of clients who are long silver, 16% who are short of silver, and you've got a very similar sort of dynamic, very long market in some of the cryptos there as well. So our clients are generally quite upbeat. I think let's quickly go back to that silver chart, because silver's an interesting one. Look, on the daily, you've got that outside day reversal. The bulls have taken to a new low. They've closed above the high. We like to see that situation now. Can it push through that range of highs? Let's go into the hourly chart. Silver needs to break through this 25-28 region. If it can close through there, then I think we're going to make a move up into 25-55. Again, just using that momentum. Market, show me that you mean business. Show me that there's going to be a continuation of this move. So silver's one I've got on the radar. If it can break and close on the hourly, I think we'll probably make a move up into 25-55. That looks the stronger market at the moment for me, and you can tell why so many clients are long. We've got this outside day reversal playing through. Can that build, or are clients now going to, or traders going to sell into this 5-day exponential moving average? That's one that we're going to be looking at very, very closely indeed. Can it sell off at these highs? Can it sell into the 5-day? If this starts rolling over here, I'd be looking for shorts. If it can break above that, I'll be looking for 25-55. So we've gone through the markets, we've gone through the charts, we've gone through the positioning, we've gone through the flow. Look at that 10-year treasury into the Fed meeting next week. It's going to be a biggie. See what's going to happen. Leave your comments below. We trade it with Pepperstone.